Good afternoon, everyone. Thanks for taking the time out to attend. We hope to provide you with an update and some things to think about and help you try and learn through, as we're all adapting to these new regimes, particularly JobKeeper, which seems to move around every day, and all of the other government announcements that they make at least twice a week. All right, so I will get into my section of it around risk and talk about that in a general way. Then I'll hand over to Betty and to Joel to talk about the bank sort of responses, and then JobKeeper and tax issues as part of what they are looking at. And then we'll deal with the questions at the back end, and most of those at the moment seem to be JobKeeper, which is logical when the government puts out a 12-page document to try and help people understand things. It's obviously pretty complex. In terms of where we are with our clients in actions that we're getting them to look at and position themselves so that they understand where they are, what they can access in terms of government grants and stimulus, and how they can protect their business. We're taking them through a very simple sort of structure. Understand where their position is and detail, particularly for those who are going to have to go through an audit process the next 3 or 4 months, detail what has occurred and what impact has occurred, what is expected to occur, and how it's being mitigated, and then what 2020 looks like. That obviously will be useful for banks as well, and for the ATO and for all of these things. So putting one document together makes it easy and transparent around all of those things. And then that document can be used as a base to work through into the next phase, which is estimating the cost to continue, whether you be in hibernation or not, and understanding how those costs are affected on a variable basis or a non-variable basis, and some of them which are pretty much rusted on fixed costs, and whether there's an opportunity to be able to change those, or whether you're stuck with that structure for the immediate period, and what that means with your government funding options or what other funding you need to. Because that's the next phase we work through into, which is, okay, here's the base cost of what we have. Here's where we know we're going to get to. Then how do we fund any shortfall, or what can we access to sort of soften the blow through that? JobKeeper is a major part of that. There's also the other PAYG implications, and there's the statewide issues as well, which need to be incorporated. Then there's opportunity to be going and look at the 250,000, which Betty will talk to, that the banks will provide, and then other facilities over the top. It's safe to say there is money floating around for the right businesses, and they just need to have a plan around what they're going to do with it and how they're going to add value from it. There are also some people who are actually using money to go and buy things at the moment, other businesses, or consolidate or whatever else. And funding is still there at reasonable prices, but some of it is more expensive depending on what you're going to use it for. The outcome of those 3 things above lets you get to a stage where you understand where you are and where you're going. And any concerns, particularly for not-for-profits where there isn't actually a profit motivation, but there is considerable concern from talking to them around director obligations, is looking at a safe harbour review to be able to deal with those director obligations and make sure there's comfort around the options being considered in the process going through, and give clarity around some of the things or some of the assumptions that have been made so that they have been stress tested, and what other options there are outside of just continuing the way things are. And then going forward, we don't know how long this is going to be like this. There's all sorts of rumour and innuendo going around at all time. The government is saying yes, no, in between on different matters. There's obviously an issue around schools going at the moment. Everybody just needs to try and make sure they consider their options and monitor them going forward. So the basic principles that we're getting through with a lot of those, what a lot of our clients at the moment are giving real clarity for those people, particularly now that everybody has come to a realisation position. We've gone through denial, we've got through realisation, and people are trying to actually do things and want to do things to understand where they're at. And that's where we're getting to with a lot of our proactive clients, and they can see, and there's a emotional value to that as well as the financial understanding that you get. So the major thing that we see in the poll question is that a lot of people think that they're eligible for the government stimulus, but when we drill into it, it's a little bit different. So one of the things we think that everybody needs to think about and confirm, and it's in our poll there, are they eligible? And have they checked that? And particularly JobKeeper, which having sat on a webinar this morning for an hour and a half, I think I have more clarity about it, but it's still uncertain for each individual circumstance. That's the framework that we've been working through. What are some of the practical issues that we've been getting into, which is on the value add that we get to on the next page. So the value add things, where we've been getting to, the big one on a cash flow basis that we've seen is looking at cash accounting for GST. The worst thing you need to do at the moment is actually be paying cash out that you haven't been paid for or recovered. And there's obviously considerable timing delays coming through with some clients with debtor collections, and where the bad debts now need to be adjusted as well. That can create a lot more cash in businesses, particularly where they're issuing the busy period of the year now, and they may well not get paid for 2 or 3 months just because people are going to take their time paying them. We also have looked at stand down. We did a webinar last week with a lawyer who made some very, very clear points that stand down may not be the best option for certain businesses and some employees. Everybody needs to consider that before they do it, because everybody's obviously trying to avoid redundancy where they can, but there needs to be consideration around what structure is the best for each individual business. Stand down could create some issues down the track, whereas other structures may not. And obviously that will also impact on what type of structure people or employees are in, whether they are in an award or whether they're under individual contracts. So a little bit of advice can often save a lot of money and give you a lot of clarity. And we have a few guys who we've been using on that, and we've been doing it with our own business, and it has made a difference. Related party funding security. This is one of the things I suggest strongly. If you're going to put money in, that you should take a registered security as part of that. First of all, it's fair if you're putting money in to fund a business and pay for creditors and pay for employees. And it gives some protection for the family wealth ahead of the family business. This means if things come out the other side and the market doesn't recover for an extended period, it still gives protection for that investment or that funding that's gone in. And it gives the ability for the funder to have a seat at the table, no matter what process is going on, whether it be even a receivership or a administration, because they get a seat at the table about making sure that their debt is recovered. So it's not only a thing to protect the recovery of that and make sure that people are prioritised for getting that money back out, it will also help, even in the worst scenario, hopefully make sure that there is some protection and a say in what happens going forward. And then the last thing is the hibernation and the spring plan. A few people are now turning their minds to what happens when things do return, and there is a return to some level of normality, that being in 2 months or 3 months, and whether and how that all works with long-term social distancing, which has been flagged this week. So how people would be able to deal with employees not being able to use public transport, or using public transport like they do in Taiwan, where everybody has to wear a mask, which I don't know will be practical in Australia at the moment, and how all those things work and how they will all impact their businesses at a practical level. Then the other really financial issue is, how can you get access to new stock? Will that be on cash on delivery terms or rent? How will that be funded upon return? Because obviously a lot of businesses are depleting their cash reserves to actually continue to hold themselves together for this interim period. If there's no money out the other side, all of that good work can be undone because they can't actually then go back to an operating level. So there are some things being looked at for that, and some proactive clients are obviously doing that, and Betty will have probably a couple of comments around that when she gets through it. So that's pretty much where we are. We are helping a lot of people identify their issues and trying to work through them. There's a lot of opportunities coming through at the moment on buying and selling, and then there'll be a few more which is around the restructure and helping people get that plan in place, and then looking at the options about how they protect themselves and their businesses. And that's pretty much it from me. So I'll hand over to Betty, and Betty's got the important stuff about how you get a hold of cash, and that's more important than anything else at the moment.
Oh, thanks, Todd. Thanks very much. Look, I won't go into detail about the government-backed lending to small business and the resi side of it, because I believe it's already been said. You're going to put that slide up, Tanya? Please, thank you. Yep, that's it. But what I'll do is I will talk to you about just some case studies that I'm currently working on. So I've got a current small business client that is anticipating, if the property market does continue to deteriorate, that his business will be impacted because they are property services to property. And so he's a current existing client of ANZ's business banking. So what we're doing with ANZ is we're looking at establishing this $250,000 unsecured facility for them. And it's purely at this stage a contingency fund for them. So if the market does continue to deteriorate and their cash flow is impacted, that they can dip into this these funds for, of up to $250,000. So with regards to what the banks are looking at when it comes to lending this unsecured facility, they do look at potentially, they would want a most recent P&L. They don't necessarily need a forecast. They do need a good story as to why you need the money. And you also need to show cash flow as well as to how, after the 6-month interest only period does expire, or it's actually a 6-month interest deferral period, you've 2.5 years to amortize the debt to zero. So they do need to understand how you will amortize the business facility after the 6 months expires. So that's what I'm currently looking at for an existing client. With regards to the residential side of it, I've got, which is the next slide, I've got a client, it's not necessarily a deferral of interest. In this instance, my client purchased a property in early March before the COVID-19 lockdown, with a view of selling their existing property in later in March. So they secured the property in early March with an extended settlement period, put their property on the market in late March, or around the time that they purchased it. But in late March, when the lockdown restrictions were issued and open homes were no longer available, they were all virtual, they've no longer been able to secure the price that they needed to sell their current house at. So we're now talking to their bank about lending them money to purchase the property that they've acquired in early March and keeping their existing property. So essentially we're looking at extending quite a bit of debt to them. I mean, in this instance, they've got the income to support it. We've had to look at living expenses and really reduce those and have a good story to tell as to why we're now declaring living expenses will be less once we have this new debt. But yeah, it's a very unique situation. They do want to sell the property, you know, when the market picks up in the next 12 months to 2 years, you'd hope. So yeah, so they're the two real case studies that I'm currently working on with the banks that are specifically around the current state of the world. So if you want to have a chat to me, let me know.
We had a webinar last week, and I see some of you are back this week for another instalment, because certainly when I was discussing JobKeeper last week, there was a lot of detail that we didn't have at that time around the mechanics of how you would qualify for eligibility, how it is that the practical aspects of registration would occur. Now, there's a lot of issues still out there with the JobKeeper program, but the bottom one, really key messages from my perspective are we're now much more aware of the time constraints, because everyone who's potentially eligible for these JobKeeper payments is now aware that they have to report on their eligibility if they're eligible within 7 days of month end. So there's this time constraint to it. We're aware of the potential cash impacts for a lot of business, and unlike a lot of tax issues that I get to discuss, these are actually favourable tax cash flows, which is probably unprecedented while I've been working in the field. And also that we have a great deal more clarity about the thresholds, the hurdles that businesses need to jump over to qualify for eligibility to get into the scheme in the first place. So a lot of that clarity actually came about because on the 9th last week, the Treasurer released a series of rules around the JobKeeper program, and what that allowed us to get a lot clearer about for a lot of taxpayers was how it is that you qualify for JobKeeper and how you make those notifications. There's two really great resources that are freely available at the moment. The Tax Office has released a lot of detail about how you go about the practical aspects of notifying eligibility for the JobKeeper, what it is you have to do to notify your employees, what it is you need to do through your single touch payroll to ensure that you get the full amount of the payments as quickly as possible. Now that's on the Tax Office website. That's a great checklist. For the policy aspects, that is, how is it you become eligible? What things do you need to satisfy? How is it done? When do you do it? The Treasury's released quite a bit of detail around that. So I suppose also just to let you know, coming up for other webinars at the moment, we have the not-for-profits for tomorrow and also for the HLB community on Friday. So there's quite a bit. Hopefully you'll find information either here or in the webinars that we're doing later in the week that'll help your business understand whether or not you're eligible and what the next steps are to do. Well, a first issue that I thought I'd touch on here is that we now have the rules released by the Treasurer around eligibility for JobKeeper. We know now that with the exception of April, if you're entitled to the JobKeeper payment, you have to make a notification within 7 days of the end of that particular month. Now for April, if you are eligible for the JobKeeper program, you can effectively notify that during the period of April. So a lot of taxpayers would be in a position there where they will become entitled to the JobKeeper program commencing in March. So they're already aware of it. These are businesses where I suppose you've already seen the decline in turnover happen during the period of March. So for not-for-profits, 15% decline. For most businesses, 30% decline, or for businesses where you've got an aggregated turnover over $1 billion, a decline of 50% or greater. Now, I can see some really good questions coming in, so I might just hold those over until the end and then go through each one of these one by one, if that's okay. We also know a great deal more about how it is and when it is that you qualify for meeting those turnover threshold requirements. So basically, the way that you qualify is you have a choice, and this choice doesn't rely on how it is you're preparing your activity statements at the moment. You have a choice between testing on a month-by-month basis or on a quarterly basis, and you can qualify for any of the months March to September 2020. Each month is tested separately, and you work over how the basic test is that you work over what your turnover, you work out what your turnover was for that particular month, and you compare it to the comparable month 1 year before. And if that has decreased by 30% or greater for most businesses, that will mean that you are then potentially a qualifying employer. From that point onwards, regardless of what happens with your turnover in the future, you are potentially eligible to get the job seeker payments. Now, the job seeker payments and the way in which you test eligibility run in quite a different cycle. So job keeper payments are paid effectively on what's called a job keeper fortnight. So on a fortnightly basis, you can become entitled to that $1,500 of wage support per employee per fortnightly period. Now, if you're doing your testing either on a monthly basis or on a quarterly basis, you become eligible if you do the test on your turnover and you determine that you are eligible in that particular fortnight. And that can be on the last day of the fortnight, for example. Now, if you are in that circumstance where you are potentially eligible, not only do you have to tell the tax office of your eligibility, but you also need to send something out to your employees. Once you're eligible for JobKeeper, you have to notify all of your employees that you're proposing to make payments under the JobKeeper program. And then they need to basically respond to that and confirm their eligibility. And in some circumstances, an employee can come back to you and say, I'm ineligible because, for example, if they have another job and that employer has already claimed the JobKeeper payment, then it's not possible for you to be able to claim it as well. And so, look, a couple of different practical things that come out of that notification requirement would be, First of all, the non-financial aspect is that you are signalling, I suppose, to your employees that you've qualified for the JobKeeper scheme. And for those informed employees, they then become aware that the business has had a decline in turnover of whatever that threshold is. For most businesses, it's 30%. For other businesses, it can be 15% or 50%, depending on the size of business and if you're a not-for-profit. Now, that of itself can create a few issues with explanatory things. And also, as a documentary thing, you actually need a positive response from your employees about their eligibility. Now, certainly, we've seen the same thing, is that getting any type of compliance done in the current remote environment is really quite difficult to achieve. And now just to touch on, so going back to the testing for whether or not you've had a decline of 30% or greater, you're not obliged to choose either the monthly or the quarterly. You can use either of those two tests to establish your eligibility for a decline in turnover. You don't have to wait until the end of a month to do it. So for example, in the Treasury materials that have been released, there's an example there where the taxpayer in that case has estimated or projected that they'll have a decline in the April period, and they do that on the 6th of April and therefore become eligible to apply the JobKeeper payment, even though they've estimated that it would happen, or they've made that assessment on the 6th of April. So you are able to make a prospective assessment of what your turnover is for a particular month in that month, and then become eligible for the JobKeeper payments thereafter. Now, the releases on the Tax Office website have indicated that the first actual payments of the JobKeeper to eligible employers will occur only from the 4th of May. The practical issue with that will be that, for example, you have to effectively cash flow fund until the JobKeeper payments become available. Once the system is up and running, the rules say that employers who are eligible should get their payments no more than 14 days after the time at which you make your notification. So once that JobKeeper payment system is up and running, you have to notify within 7 days of the month end of employees for whom you have, who you've qualified and wish to claim the JobKeeper payment. And then within 14 days, you should be receiving the cash flow that comes from the government for the JobKeeper. Now, for a lot of employers, I'd say maybe 80%, the turnover tests, once you establish them, they have an understanding, okay, in most cases, I need a 30% decline. I need to be able to demonstrate it. There's a slight issue if you want to do it based on the projected turnover. It's a bit of a risk there, whether or not you actually do ultimately have the decline that you expect. We'll hope that our business turnover is not going to be as great as that, but in some cases, it's possible that you might expect that you're going to have a decline in turnover for a particular month, notify of your eligibility, but ultimately your turnover is a little bit greater than you expected. We also know a little bit more now around the way that the turnover is tested. It's adopted a GST style definition of what turnover is for a particular period. And what that is basically based on GST taxable suppliers plus GST free type suppliers. And for a lot of taxpayers, that's caused a little bit of concern because, for example, if your business is principally around making input tax supplies, then you really have a challenge to try and work out how it is you'll ever satisfy the drop in turnover test. Or alternatively, another one that we're seeing a lot of an issue with is for businesses that are pre-revenue. That is, they don't actually have a lot of turnover from a GST perspective because they're in build-up phase. They are situations in which it'll be really hard to demonstrate that the basic test applies. A third situation that I see as being a real emerging one, and one with which a lot of taxpayers are going to need help to understand if they're eligible, is that for a lot of corporate groups, you might conduct your business activities in a range of different businesses, and each one of them can be tested separately for a decline in their business turnover. But in addition to that, what we often see is that even though you might have a lot of different entities, companies and trusts operating different businesses, employment is often centralized or placed in an entity which is not the same as the one that faces off with customers and clients and so forth. And the challenge there is that there doesn't seem to be a clear mechanism in the rules which have been released by the Treasurer there to connect the entity which acts as the employer with the businesses that actually use those employment services. And so what we'll need to look at there is the basic test is the one I've referred to there as the basic turnover test satisfying the 30%. There's also some prospect that the tax office can release a series of alternative tests to satisfy. And what they will be looking to do there is to cover situations where the basic turnover test doesn't give a good reflex of how the business has gone through a decline over the COVID impact. So for a lot of those type of businesses that don't fit the classical steady state revenue and turnover requirements, or they do something a little bit different, or they're pre-revenue, I think we will need to spend quite a lot of time seeing how the tax office evolves their view around this alternative test, and also to help them potentially look at eligibility. Bearing in mind, of course, that essentially it's a use it or lose it system. If you don't notify the tax office within the required 7-day period, you can miss out on those payments altogether. So it's one of those cases where it's certainly worthwhile for employers and businesses to notify that they are in the system, and then certainly to make a claim for the payments with some kind of a basis. So bearing in mind that we don't expect to see cash payments come out of the tax office until the 4th of May, we do have a little bit of time on our hands before to wait and see what the alternatives that the tax office might release for eligibility are. You'll see in front of you here, I've got a poll question here for JobKeeper, and this is evolving. What's really interesting for us to appreciate from a lot of clients' perspective is how they see the JobKeeper at the moment. Some are definitely in, some are definitely out. Some have to wait and see at a particular time they might fall into eligibility, and some are just outright confused by the complexity of these provisions, which is frankly an equally acceptable response, because there's a lot of those ones there. So Todd, the questions here, which one did you want me to cover first?
I'll read them through so everybody can hear them.
Yep.
Can we add new hires after the 1st of March to the JobKeeper program?
So eligibility, I believe, runs from those people who are employed on the 12th of March.
Okay. So, and if it's after that, they'll have to wait till April. Is that right?
So I think this was one where, so I think at the moment, if you're not employed on the 12th of March, you're not eligible, but I have to go back and have a look at that one.
All right. And
so March, yeah, so long as they continue to be there on the 12th, you should be eligible.
Okay. If revenue in March was not impacted, but April was definitely down, can the business register and qualify for April JobKeeper?
Yeah, that's a great question. Thanks, Mark. So yes, that is the way that the turnover tests work. So even if you don't qualify in March, you can test again in April, and you can test again in May, and you can test again in June and July and August and September. And you can also go ahead and test on the quarter of June, or you can test in the quarter of September. And if you satisfy for any of those periods, then you become eligible from that point onwards for the JobKeeper scheme. So just because you miss out in March doesn't mean that you're out altogether.
All right. What does payroll at 1st of March mean? E.g., can a business owner who is on the payroll but is paid in line with profitability and may not have been paid for 5 months qualify as an employee on the payroll at 1st of March? I would have thought that will be impacted. Also, what's in your BAS for March, which a lot of people have not lodged yet?
Yes. Look, so that will depend on how it is that you go about characterising the business owner's payments. Some business owners pay themselves through dividends, and that's not the type of relationship that will qualify for JobKeeper. But if you are that type of situation where you're remunerating yourself as and when you want to, or as and when the business needs are there through the pay-as-you-go withholding system, yeah, look, that does potentially qualify for the JobKeeper payments.
Some other ones that we had earlier. Has there been any discussion for startups with no sales history, including mining companies that are just in investment phase?
Yeah, look, that's another great one. So that was that example I was talking about before, is that if you have effectively revenue or turnover now of 0, and a year ago it was 0, and it has actually been 0 more or less for the last 6 months, very difficult to see how you're going to pass the basic test. That is that you had a turnover which decreased 30%. And so to qualify for that, you'll have to have a look at the way the tax office interprets their powers there to have an alternative test. I really don't know how that's going to work, because when I read over the rules this afternoon, the extent of the ability to exercise your discretion around an alternative test seems to again focus in on an alternative turnover test. And turnover is just a completely inappropriate test for a business which is pre-revenue. I don't know exactly how that one will play out, but I suspect we might see a little bit of movement on it.
That'll be, I mean, the ATO is going to have control of a lot of things, and I hope they do some pragmatic and practical sort of approaches with a few of these issues, and then give some clarity.
Well, you'd hope so. I think we'll just have to watch and see how the tax office evolves these type of pre-revenue cases, because they have employees in exactly the same way as other businesses do. So
yeah.
The choice as a policy thing to just focus on turnover, I hope that doesn't. I can't see a policy
exclude
reason.
people.
I can't see a policy reason why those type of businesses should be excluded if they are
Yeah.
engaging in employment or would be impacted by their ability to continue to employ based on the COVID environment.
Here's a good practical one that we had. Single touch payroll reporting for entities only on monthly payroll. They can stay on monthly. They don't need to go to fortnightly to be eligible and be able to remit, do they?
Hey, yeah, that's another great question. So one of the speculations was last week before we saw those rules was that, okay, if the JobKeeper if the JobKeeper payments happen on a fortnightly cycle, and you have to make a payment in a cycle to be entitled as a business, does that mean you have to flip all of your employees over to a fortnightly or a weekly basis to make sure they all qualify for JobKeeper? So what we've seen now from the rules which have been released is that no one's going to have to do that. So there's a provision in those rules to basically take a monthly amount and segregate it and allocate it to different JobKeeper fortnights, so that you're not going to have that situation where you need to artificially manufacture a change to your payroll systems to enable people to qualify for fortnights where they're usually paying their workforce on a monthly basis.
Okay. Another one. Say for businesses which have March and April equal to the previous year, but no sales in June, which means the June quarter is 40% down, can claims start from 1 April, being the start of the quarter?
Yeah, so that's a great example here of how practically these turnover tests work. So any business can choose either to test one or both of on a monthly basis or a quarterly basis. So if you're testing on the monthly basis in that example, you're not going to qualify for JobKeeper in either of April or May, but you will qualify in June. And the first time that you can make that test is within the period, so that's June. But if you make that assessment, that is, you test using a quarterly period, and because you'll have no sales in the June period, and that then means that your whole quarter effectively will satisfy. If you're using that quarterly test, you can test on the 1st of April of eligibility for JobKeeper. And because you're considering both of the tests at the same time, the practical difference is if you're using the quarterly test there, you can actually satisfy theoretically from the start of April, start making JobKeeper payments in April, start becoming eligible for JobKeeper payments in April. Whereas if you have to wait until June, of course, that means there's a whole raft of JobKeeper payments that you're going to miss out on for that intervening 2-month period.
So on a similar one, so if you've got a BAS that's on a cash basis, right? So you do your GST cash wise. Let's say that there isn't any, if there's no sales in May and June, but clients are paying invoices from February and March, which means that your BAS isn't down 30%, but your actual operations are down 30% because there's just a timing difference when you're getting your receipts, even though you don't have any sales that you're making in May and June. Does that mean eligibility would start from when your sales drop away, being in April?
Well, actually, so your eligibility is tested on what your projections are. So you don't actually have to wait until the wave hits you before you start becoming eligible. So in that case there, if you know that your projected sales will drop away in June and you adopt a quarterly basis for assessing it, then you're entitled to start to assess your eligibility starting from April, and you become eligible in April.
And here's a live one for discussion. does JobKeeper attract annual leave and sick leave accruals? It's probably both of us. What's your view, Joel?
Well, look, I would have said in 99% of cases, people will be getting paid more than the JobKeeper amounts, the $1,500 per fortnight. And if I can just look at that example there, I guess the employee is not seeing any change to remuneration. So I'd say, yeah, really annual leave and sick leave pretty much run as usual. How do you see that, Todd?
I see it as it depends on the structure of where people are. If people are stood down, there are certain rules that apply for annual leave and sick leave. If people have agreed to take leave without pay, but they are receiving an amount which may well be the JobKeeper plus a top-up, that will be different. So there will be slightly different rules in depending on each scenario, and obviously there will be the impact of each wage structure being whether it be by an award or whether it be by a contract as well. And that's one of the things that we see that people need to get a little bit of advice around, because it is a little bit complicated around how that will work. And obviously you don't want to have stood down employees accruing a raft of entitlements that creates a liability down the track unless you know that that's what's going to happen. So that's one of those unintended consequences that people need to try and navigate through. And another one, if you determine at the end of April that we're eligible, can we claim for the fortnight starting the 30th of March? So I'd say that from the start of April.
Oh, okay. So Salil, thank you very much for that question. So there's a lot of emphasis placed in these provisions around the time when you actually do the testing around your turnover. So to be eligible in the fortnight starting the 30th of March, that means that sometime during that following fortnight, you must have tested and satisfied the test that you've got a turnover drop. So if you wanted to qualify for the JobKeeper fortnight starting the 30th of March, you pretty much have to make that assessment by the 12th of April. And if you don't, then you won't satisfy for that period. But for the next JobKeeper fortnight, if you do make that assessment around turnover during that particular JobKeeper fortnight, then you would become eligible for the JobKeeper in that period.
So people need to start making assessments pretty quickly.
Well, yes. The maximum JobKeeper benefit flows from assessing early. Having said that, if you assess too early or based on incomplete information and you get it wrong, the challenge is that, right now we think about positive cash flows. In a year's time, undoubtedly, in the cold light of day, there will be some attention from the tax office around these assessments. So the cash flow wise, it's always great to assess early that you're eligible, but it pays to get a little bit of assistance to back up what or give some robustness to whatever your assessment around the drop in turnover is.
And on that, one of those other queries that people are coming through, because there's varying sort of language used from Treasury and from the ATO, is that Treasury says that your turnover has to be assessed on the relevant month or quarter based on your BAS reporting period, so whether you are quarterly or monthly. But the ATO has said, look, it's open whether you want to assess on a monthly and quarterly, hasn't it? And the ATO is the governing body effectively here. Treasury is just the ones putting the cash in.
Well, look, I'd kind of go with it's having read over those rules now, because we know a great deal more this week than we did last week. Those rules seem pretty clear to me that regardless of what you do in your activity statements, you can assess your JobKeeper eligibility based on either criterion.
Whichever one works best for you.
Well, that's it. So another thing I would say is all businesses are helped by continuously reviewing what your expected turnover for the month and the quarter is, because if you don't notify within the requisite period, or you don't think about it until later on, you will miss out on eligibility for payments that you'd otherwise be entitled to. So, and worst case is you discover you're not eligible. At least you've got that extra information where you haven't missed out on cash that your business really needs at the moment and might be entitled to if it just did something timely and well advised.
Yep. All right. Is there any other questions people want to throw at us? So there's another question there for you from Salil. Any inclusion for parent company providing shared service with no revenue to qualify for it?
Yeah. So Lil, this year's one of the biggest issues. I've read over these rules that came out over the weekend. So I think what Salil's pointing to here is if we've got one entity which is essentially acting as a services provider, and other entities within the group that actually, I suppose, outwards facing and providing services. There's no real discussion here of how it is that we go about connecting two entities where one is the employer and another one which is the one which conducts all of the business. I would say at the moment the sensible and logical thing is that you're going to effectively look at the decline in turnover of the outwards facing businesses and the eligibility for the employer, which is probably a different entity in a lot of cases. And those two will be connected, but I can't actually see the mechanical provision that draws those two together at the moment.
So is that going to be one of those practical things that the ATO is going to work through as it comes up? Because there will be a lot of services businesses who will be in that, and large employers, a lot of those entities.
Yeah, that's certainly what I see in the corporate space, is that if you're running multiple businesses, you typically want to have just one entity, either because your secured lenders require you to have a special entity, or alternatively, because from a compliance perspective, all of the compliance issues associated with employment multiply the more entities that you have acting in your group as an employer. So it's very frequent in my experience to see one entity within a group acting as the employer and it does nothing else, and then other entities which are actually outwards facing. So I think it's one of those ones where we're going to have to watch and see how the tax office position evolves with this alternative turnover test that they've got.
All right, we got one from Mark as well. Does overseas parent revenue get included in the assessment of the $1 billion threshold?
Hey, great question, Mark. So what we know about, confusingly, they've decided to put these rules into place with two completely different tests as to what's included in turnover. So for that particular turnover test, they're looking at what's in small business entity rules. So you have to include in your aggregated turnover all of the ordinary income of entities connected with you. So if you've got a foreign parent, might be completely unrelated to the Australian jurisdiction. If it owns 100% of you, then you'll have to include all of its turnover and also all of the entities in which it has control. So if you're looking at a multinational type situation, for the purposes of the aggregated turnover test, you have to include all of your parent entities and all of your sister entities as well for that $1 billion turnover threshold. And in a lot of cases, that will mean multinationals are in a situation where they're much more likely to end up needing to show a 50% decline in turnover to gain eligibility for the JobKeeper.
Okay. Any other questions? It is a moving feast and it will continue to evolve, and hopefully the ATO can give us some more clarity going forward so that everybody has a little bit more certainty around what they can do and what they can build into their cash flows. We're certainly helping and looking at building a document and a tool for our clients to help them to confirm their eligibility, and then making sure that they apply it the right way, because otherwise in 12 months' time we might have other issues. But at the moment, I'd suggest getting in, trying to be eligible, and then assessing and applying to be eligible, and then assessing it afterwards as much as you can, and make a considered document around why you think you are eligible, and go through that process. Is that right, Joel?
Spot on, Todd. Thank you.